record on the computer. So our last part of the discussion, we looked at capital rationing. And we said in capital rationing, what you needed to look at. Maybe we didn't do an example, but look at an example on capital rationing. Probably example on capital rationing before we start our today's discussion. We are going to move a bit faster so that we can finish the investment today. So let's look at this example before we, it's part of what we made in our previous class. So company X has received 8 investment projects from the project team as below. So these are the project 1, 2, 3, 4, 5, 6, 7, up to project 8. And this is the amount required, the initial outlay of the project. And this is, I added the wrong here. I added the NPV and I wanted this one. Maybe I can increase here. So the whole projects require 1.8 billion for investment. The management team has provided, maybe I can add here, has provided 1.2. 1.2 billion for the next investment. That's the money required. So automatically, by looking at this, by looking at the total amount that is required, 1.8, and this amount that was allocated, automatically it tells you that there is a capital rationing. By just looking at the total amount which is required and the available funds, automatically it tells you that you are dealing with a question that requires a capital rationing, because all the projects are profitable because they have a positive NPV. The money required to invest in all those projects, if the funds are available, you would have required 1.84 to invest in all these projects. But because funds are limited, you have to exercise a capital rationing. You have to, yes, please. Where you go? Oh, you're on the phone. So that is a capital rationing decision. So sometimes you may not need it to be. Just look at the funds required and the funds available. Make your decision. Look at whether you are dealing with a capital rationing or you're not dealing with it. Sorry, I'm coughing. So then the required is assuming the projects are divisible, show how resources will be allocated. And what will be your answer? The projects are not divisible. Now, when you are dealing with this, as we said, when you are dealing with a divisible project, your decision is based on profitability index. If you are dealing with if you are dealing with the divisible projects, your decision should be based on profitability index. So if I can maybe copy the same information down here. If I can copy the information down, what I need here is my PI, the profitability index. Then after getting the PI, I need to rank the project depending on the profitability index. Now, if you look at this, I have the NPV. How do I get the PI? You remember in our discussion, we said PI is equal to PV, the present value, divided by the present value of cash flows, divided by the initial investment. Or you are getting the NPV divided by IO, then plus 1. So it means in this case, I'm going to use my PI. So I come here, I'm just going to use the formula, I think. It's going to be this, divided by this, then I add 1. I've used the second formula. So it means in my project 1, the PI is 1.65. So I can maybe scroll down now. Those are the PI in this. Now, what do I need? Now, the second step, is to rank my projects. If I'm ranking, I'm going to rank this as project number 1. It has got the highest. Project 1. Then this one is going to be project number 2. I think this one is project number 3. This is project 4. This will be project 5. Project 5. This will be project 6. This will be project 7. And this is going to be project 8. I've done the ranking of the projects. So it means when I'm allocating, I will allocate the resources depending on the rank, on the order of the ranks, from project 1 until the resources that are required are finished. I mean, until the available resources are finished. Now, once I finish that, I do on allocation of resources. Remember, our project number 1 is we are going to allocate project 5. These are the project. Then I recognize the initial investment of the project. Then what it required, allocated funds or allocation. Then the NPV of the project. We are allocating to project number 5 first, because it is our number 1. Project number 5, it requires 300. Its NPV is this. Hey, so the amount we are allocating is the same. We are going to allocate this. And its NPV is this. Another project where we are going to allocate project number 8. Project number 8 requires 200. And we are going to allocate 200 on this project. Then the resource, the NPV of the project is 140. The third one, where we are going to allocate, is project number 2. We have project number 2. Project number 2 requires 180. And how much I'm allocating? The same, 180. What is its NPV? NPV of project number 2 is 120. Number 4, the next project is project number 4, which we have ranked number 4, which is project 1. It is project 1. Project 1 requires an initial investment of 100. And we are going to allocate the same amount because we still have the resources. The NPV for this project is 65. Remember, we cannot exceed 1.2 billion in our allocation. This is already, we have around 700 plus. So the third project, the fourth, is project number 4. Project number 4, it it requires 80. It's going to give us an NPV of, hey, the money we allocate, we are allocating the same amount. It's going to give us an NPV of 50. Then the next project, we add here, we have how much? We still have the resources. We have 860, still have the resources. I go to project, I have branch number. Project 6. It requires us this amount. It will give us, we shall allocate the same amount, and it's going to give us an NPV of this. So how much do I have now? 1.1. Yes?
Number 6 requires 450, I think.
The one with, no, 450 is in number 8.
Project 6.
Project 6 requires 280.
Sorry?
It requires 280. Isn't it? This is the one which is wrong number. Don't look at the number.
Okay. Now I see.
Yeah, this
The
is
ranking.
Yeah, now I get it.
Okay. Now, the next project, remember now, if we add here, you have 1.140. You only need 60 to finish the available funds. So, but since the projects are divisible, you can start this another project. And so it means we are going to project number 3, because it is the 7th now. Project number 3, it requires an investment of 250. But basing on the available fund, we are only remaining with 60 to finish the funds. So it means the funds have been exhausted. 1.2. And these are the funds which were the project required. It required that, but we have allocated 1.2. What will be the NPV for this project? Because you are doing it partly, you're not going to finish the project. It means you must make a proportionate. Hope we are getting each other. You are going to make a proportionate of the project number 7. Well, I think project number 3. Sorry. We are making a proportionate of the funds allocated divided by the funds required.
Excuse me.
Then multiply by, yes, please.
Here we are under the assumption that the projects are not divisible. So the project.
We are answering part A. The projects are divisible.
Okay. Okay.
Isn't it? So this is how we are going to allocate the funds if the projects are divisible.
Come back a bit on the formula.
Oh no, you get the funds allocated. When you want to allocate the funds allocated, get to this one. The NPV for the last one where look at the funds allocated over the funds required times the NPV of that project. Funds allocated divided by the funds required times the NPV of that project. Then you are going to get the NPV to allocate. for that allocated, for that project you are going to do part.
Can you put the formula on the top to help us?
Where, around here?
No, NPV.
Huh?
On the NPV.
Because we are looking at
up.
it. No, this one is the same. We are not getting it. The only way you are calculating is here. Because you have allocated the money. You have not used the whole money. For this way you have used all the money. You don't need to allocate the NPV. So here we only look at the proportion of the NPV for the funds allocated. Maybe I can write it here or down here.
Yes.
Proportion of NPV for the funds allocated. You are getting funds allocated divided by funds required. Then times the NPV. Sorry. So you'll get the fund. That's what we have done here. 60 divided by 250, then times the NPV of that project. Project 3. Then you can get this. We are just proportionating. I don't know if you have a question on this. Any question on this? Remember, we need to finish investment today. So then the next, when the projects are not divisible, if projects are not, if the projects are not divisible, if the projects are not divisible, we said what you need is a combination of NPV that gives the highest. A combination that gives you the highest NPV. That's what you are going to take. Now, if projects are not divisible, I don't know if I can take this. These are the projects. And I need a combination which gives me the highest NPV. So we can look at this, and it uses as much as possible of our sources. If I take my first combination, this is the combination. Maybe I can leave a space here. This is my combination. And I make this one the IO. And here I have the NPV. Because what I need is a combination that's going to give me the highest NPV and exhaust as much as our resources. So if I take, I think I can start with project 5 plus project 5 plus project 7 plus project 8. Remember, you cannot exceed the amount. Project 8, I think if I add project 4, how much will I need in project 2? Let's see this one, whether this combination can work. Project 2, how much? This is this, project 5 plus project 7 plus project 4 plus project 2.
Excuse me.
How have I added? I've added wrongly.
Excuse me.
Yes, please.
Yes.
Project
You are
this?
adding NPV instead of
Yeah, okay.
initial
Project
investment.
plus project 7 plus project 8 plus project 2. Hey, we can add another one, I think.
We still have resources.
But you did not pick the project 6, and it is the biggest.
With the NPV. I'm looking at the NPV.
With IU.
Now we look at the combination that gives us the highest NPV.
Okay.
We can add the project what? We cannot add this one. It will be exceeding. We can add project. We can add, I think, project. You can add project 1. You can only add project 1. Or we can add. We can't add project 7. Only add project 1. And if you add project 1 here, I think that's all. How comes? Okay.
I haven't added any project 3.
Project 3
It can't work. Yes.
Now, if you add project 3, I think it is going to exceed. Okay, let's add project 3 and let's see. We remove 1. If you add project 3, if you add project 6, it exceeds. It is exceeding.
Project 4.
Project 4 is 80, but it has got the lowest NPV compared to project 1. Hey, we can add project 4 and 1. I hope the resources are available. We can add project 1 plus project 4. Yeah, it works. So the NPV will be 5 plus 7.
Then what would that mean? If we are selecting the combination with the highest NPV, we are including the one which have the lowest NPV.
No, because what we are looking at, the resources we have, we would have selected project 4 here, this project. But taking this project, we don't have the resources. That's why we are opting for the one which have got the lower to finish our resources. Because we cannot take project 4 when we have other projects, like maybe if you have many projects. Maybe you can try then another combination, including project 4. We didn't take project 6. We took project 4. We took project 2 to project 1. That will be the NPV for those 3 projects. For those projects. These are the funds required. And this is the, then you can go for another combination. And then you will select a combination which gives you the highest NPV. Now,
is there any guidance? Is there any guidance regarding the number of projects that you are going to combine?
No.
For example, here you have combined.
What you need is to look
Okay.
at project that exhausts your resources and it gives you the highest NPV. That's the only guideline that you take. Projects which exhaust your resources and it gives the highest NPV.
Okay.
So you can try, but what I want you to maybe to look at the mutual exclusive. Sometimes, like a question, there is a question, is in 2018. You will look at that, mutual exclusive projects. Because sometimes they may tell you project 1 and project 3 are mutual exclusive. Project 5 and project 8 are dependent. So you need to look at those conditions given in the question. If some projects are mutual exclusive, it means taking one project will not take another project.
Well,
You are saying?
mutual exclusive, the one you take one project, you have to, you
Don't
don't
take
have to take
another.
the other one.
Yes. So if one project is taken, another project is not taken. Those are mutual. If you take one project, you're not going to take the other.
Excuse me, sir.
Yes, please.
If you are combining the initial investment of project 5, 7, 8, 2, and 1, I
Yes,
can't
please.
see why I can't see why you get 1 million.
There is another project 4.
Another project 4.
Yeah, probably it is
Okay.
hidden here.
It's not. Okay.
There's a project 4 which you have added here.
Okay.
Dependent projects. That is another thing that you should look at when you are looking at this part of either from the divisible, not divisible. Look at the conditions in the projects. If we say that the projects are dependent, it means taking one project, you'll have to take another project. For example, if you say project 1 and 2 are dependent, it means automatically you choose project 1, you'll have to choose project 2 if the projects are dependent. So taking one of the projects, you'll have to take the other project. If we say the projects are dependent, if you take one project, you have to take the other project. If projects 1 and 2 are dependent, taking project 1 automatically, so that is going to affect the way you're going to choose your projects. For example, you may say project 1 or project, we had the number 1 was project, we come here. When we ranked, if we ranked here, if we say this was our first project, project 5, and they tell you project 5 and project 6 are dependent. You see that automatically by choosing project 5, we would have to choose project 6. So you need to be very careful at some of those conditions in the questions, whether the projects are dependent or the projects are mutually exclusive. I think you can look at that question. Is it in 2018? 2018. Look at that question of 2018. I don't remember the seating, but I think remember it is in 2018, where we had this question on capital rationing. So I think this is what we covered when we met last time. I don't know if you have a question on this.
Did we exhaust maybe the combination?
We have not exhausted all the combinations, but you can do that. But we have not exhausted all the combination. You can select another combination that you see. I'm not saying this is the last, this is the decision. You can check another combination that gives us the highest. Can you, do you see any? By the way, if you take this combination, this one, oh, it was this combination. How much was the NPV? If you take a project T, but this one, we remove this one. You take a 5, 8, 2, 1, 4, 6. It was giving us how much? If you take these ones, so I can use the sum. It will give us it is the same that we have taken, I think. So you can please select, look at for another combination that gives the highest NPV and the C, and select the combination but gives the highest NPV. So that is what we covered in our last class when we met last time. So I don't know if you have a question, please, before we start something else. Any question?
Excuse me, sir.
Yes.
Come again on mutual exclusive. In these projects, which ones are those?
No, I didn't. I just talked about incident. In some question, they can tell you that some projects are mutually exclusive, some projects are mutually dependent. But I just wanted to give highlight. They are in this case, is not provided for that condition. Is it okay, Doreen?
Even most of the questions which are given
Yes, it's
on
okay.
the capital rationing,
Yes.
they include those conditions mutually exclusive or dependent.
Yes. That's why I gave you this, that you should be able to look at that. If it is mutually exclusive, if you take one, if say project 1 and 3 mutually exclusive, means one cannot take project 3. Take a project 3, cannot take project 1. But if we say project 1 and 3 are dependent, it means by taking project 1, automatically you have to take project 3. So the next part that I want us to talk about is the placement. The placement decision. That's the next part that I want us to talk about. The placement decision. Now, replacement decision, it's about whether to replace an asset or not. And if you are to replace an asset, when should you replace that asset? So the main issue here in the replacement is about whether to replace the asset and when to replace the asset. So this involves evaluating whether to replace an asset and when the asset should be replaced. So you may be having two assets also, or you have one asset that is ongoing. You want, when should you replace an asset? Or you have an ongoing asset and you want to say, when should you replace the, because in the asset, most of these non-current asset, as the time goes on, the residual value of the asset reduces and the maintenance cost of the asset increases. So your worries, as you are using the asset, you may find that you are going to incur high cost by continuing to use the asset than replacing that asset. So you want to evaluate, should we continue to use the asset and incur this maintenance cost, or should we replace the asset with another asset? And when should we replace this asset? Or if I have two assets operating, which one should I replace first? If of the same categories. So these are the decisions that we always make in a replacement. So the first part that we're going to look at is going to be our part one. When that's the first question we are going to look at. When to replace an asset. When should we replace an asset? So the business or the entity should replace an ongoing asset or an existing asset when it is incurring the lowest annual equivalent cost. Where you will be incurring the lowest annual equivalent cost, that's when the business should replace an asset. So the entity should replace an asset where it incurs the lowest equivalent annual cost. We always abbreviate as ESC. And what is our ESC? Sorry, it is the lowest cost in the all periods of the asset. It's the common cost, not the lowest. Common cost. The common cost in the all periods of the asset useful life. So if you look at the common cost that incurred in all periods of the asset useful life is what we call the ESC. And what are the steps here? What are the steps to determine when to replace the asset? Step number one, determine the present value of each cycle. That's the first step. Determine the present value of each cycle. Each period or each period of the asset is considered to be a cycle. Each period is a cycle. So you're going to determine the present value of each cycle of the asset. Cycle 1, cycle 2. No, if, for example, you look at it, if suppose the asset, each period is not, if the asset has a useful life of 4 years, we will have the first cycle, the second cycle, the third cycle, and the fourth cycle. So each period is going to be a cycle. Step number 2, determine the ESC of each cycle, which will be equal to present value of the cycle divided by the annuity factor. So you're going to get the present value, you're going to get the ESC of the cycle, which will be the present value of the cycle, the total present value of the cycle, then divided by the annuity factor. Then the last step is to assess the lowest ESC. Assess the lowest ESC. And that's what you are going to, that will be the cycle that you are going to take. I mean, that will be the period where you should replace the asset. Let's look at a simple example here. Company X is evaluating when to replace its machine. Company X is evaluating to replace its machine. The cost of the machine is 100 million. And we'll have the following maintenance costs and residual value. I'm going to remove 3 zeros because it will disturb me. 10,000. The residual value will be 85. It's a residual value. If we maintenance cost here will be 10 million. And residual value will be 70 or 68. We are going to incur 25 million. And we can sell the asset at 50. We're going to incur 35. We can sell the asset at 30. So that is what we have here. Required, I can even write it here. Required, the cost of capital, I have not said it. The cost of capital is 10%. So assume that. Required, determine when to replace the machine. Let's have this. So now, what we do, we said each period is a cycle. We have here 4 periods. We have cycle 4, cycle 3, cycle 2, and the cycle 1.
Scrap a little bit.
Huh?
You scrap. Little. Again.
The example is starting from here.
Yeah, it's okay.
We move on. So let's look at the cycle 4. Our first cycle. Cycle number 4. Cycle number 4, you have the period. We are assuming that the asset is replaced in year 4. That's the cycle 4. The asset will be replaced in year 4. So if we are to replace the asset in year 4, you'll have years period 0 when you invest just the asset, period 1, period 2, period 3, period 4, and period 5. Of course, this is 100 minus this will be, I took the maintenance cost.
Excuse me, sir.
Maintenance cost in period 1. Yes, please. Maintenance cost.
Why you start?
You know, the reason I want to start with the period 4 becomes simple to get of the data I'm going to use. But you can start with the period 1, but you are going to repeat everything. But when I have period 2, start with the last period, it becomes easy. Because other data will just be copying. That's why I like to start with the last. These are maintenance costs.
If it is cycle 4, where comes the 5?
No, it should be 4 again, not 5. Because we only stop at 4. This should be 4 again. And the 4, we have a residual value of the asset, which is 30. These are our cash flows. Now we have our discounting factor at 10%. So this is going to be 1 plus 0.1 power minus this. I think I can reduce like this. So this is the present value. The present value, and I just multiply this times this. So I can add, and I will get the present value of cycle 4. So that will be the cost. Suppose the asset is replaced in year 4. Now, suppose we replace the asset in year cycle 3. Will it confuse if I write it here? I go down, I can write it here.
Put
Down.
it down, it will confuse
Down.
us. It's better to write it down.
Suppose we do cycle 3. Cycle 3, we are assuming we are replacing the asset in year 3. So what I do, I just copy this. That's why I say I prefer that this one I just copy. I copy this. I think they okay, they have come out. I copy this. Hey, they are not, yeah? Is it true? As if I'm not getting the same ones.
True, but you have to add residual value.
This is year 1. No, the answers are not correct.
It's not true as cash flows are not the same.
Year 1, it should be 10,000. Why am I getting year 1 is 18? Year 4, yes, year 3 again. It's going to be what's our residual value in year 3? It is this. So if we replace here, this will be our present value cost. If the asset is replaced in year 3, that will be the cost. Now, suppose we replace the asset in year 4, we get cycle 2. Cycle 2, we are assuming that the asset is replaced in here. So I'm going to copy this. This time I'm thinking I should copy figures, not copy figures. Hmm. Okay, then I add another cycle through here, which is the present, which is the residual value. This will be the residual value. So now I'm assuming the asset is repressed. I'm going to cycle 1. Cycle number 1. I'm assuming that the asset is repressed in year 1. So if I assume that the asset is repressed in year 1, it will be so this is year 1. So it means this will be the present value. In the case the asset is repressed in year in year 1, that will be the cost. Now, once I finish this, that was first step number 1. I think if you look at our steps, step number 1 is to determine the present value of each cycle. Then step number 2 is to determine the ESC for each cycle. So now what I'm going now is to determine the ESC of each cycle. The ESC of each cycle. I have cycle.
And we put them on each cycle we have calculated.
Yes.
Can we put on the right side? Or which cycle we can?
Let's put it down here. We have the annuity factor, the cash, the PV of cycle. Then I can have annuity. Then I'm going to have the ESC. I have cycle 1, cycle 2, cycle 3, cycle 4. Cycle 1, we have got this. Cycle 2, we have this. Cycle 3, we have this. And the cycle. Then annuity. I'm going to use the formula, or if you have the table, you can take it. 10%. We are looking at annuity factor. So I'm going to use the formula. It's 1 minus 1 plus 0.1 power power minus this then what I get divided by 0.1. So that is the annuity. Now, what I get here is the SC now. And we said, get the annuity, the cycle, sorry, divided by the annuity factor. That is cycle 1. Cash flow divided by the annuity factors. So it, yeah, it gives us this, but that's the data we put in. So it means this is our lowest. So this asset should be replaced in period 1. I think, of course, the data are imaginary. If you have actual data, you get the right period. I don't know if you have a question here. Yes,
I
Why
have a
you
question, sir.
you may come again. Why you take the period you want to be used as replacement period?
We said we replace the asset at the lowest ESC. Where do you have the lowest ESC? It is year 1.
It is in year 1.
Yeah. Another question?
To calculate the ESC, it is take the PV divided by annuity.
Annuity factor, yes.
Okay.
So you should also write that formula.
The formula is here. It is step number 2.
Step number 2.
Number 2. Determine the ESC of each cycle.
Okay, I can see.
So that is replacing when to replace the asset. Another part here, or another question that we should ask, which asset to replace? The first question was when to replace. And we said we are replacing where we are incurring the lowest ESC. Now, the second part is which asset to replace. So if I have 2 assets, asset 1 and asset 2, which asset should I replace first? Still, the decision is the same. You are going to compute the present value of the cycle, each asset. Then determine the ESC of each asset. And then determine the one where you have. I think you have heard. Look at the steps. Step number 1, determine the present value of each asset at the end of the cycle. At the end of the cycle, what is the present value of that? If the asset has a useful life of five years, what will be the present value of that asset in 5 years? If the asset has 3 years, what will be the present value of that asset after 3 years? Then, step number 2, you determine the ESC of each asset. Of course, you'll get the present value of the cycles, or the present value of the asset divided by the annuity factor, which we have seen in the other part. 3, the asset with the lowest ESC should be replaced first. The asset with the lowest ESC should be replaced first. So these are the simple steps on which asset to replace, similar to what you have seen in the previous part. So maybe I can test you with this. Maybe you can give me the answer. Company X has got 2 machines. Which are A and B. For both machines, let's assume both machines were purchased at 50 million. At 50 million francs. Machine A has a useful life of 5 years, while machine B has a useful life of 4 years. The cost of capital is, let's use the same 10%. And these are the cash flows. Cash flows machine A. I have 1 2, year 3, 4, year 5. These are maintenance cost. Period, yeah? Have maintenance. It require 5 million here. It requires 7 million. It require 10 million. 12. It require 15 million. And our residual value in year 5. The residual value in year 5 is 26 million. Then machine B, one, two, three. It has a useful life of 4. Maintenance cost. Then our RV in year 4, 30. So, which machine should be replaced first? That's required. So that is the data we have. I hope you can handle this. These are 2 machines that you are having. Okay, maybe not to take a lot of time. We're taking machine A. Machine A. So this is our residual value. I don't know how I can make this one. I need year 0, year 1, year 2, year 3. Year 4, year 5, year 5. Let me make this one a minus. Hope it will not affect you. So you are going to do what's the present value of the asset at the end of your cycle. So I'm going to do the discounting. Target this times this. So if I add, I will get this. That will be the present value of this asset at the end of year 5. Then, if you go for machine B, or I can even compute my ESC. So what will be the annuity factor at the end of year 5? Annuity factor at end of year 5. So I think I can get it here. So it means my ESC will be that for machine A. Now, if I go for machine B, I don't think it's almost the same. I think I can even do it. Machine B. Period 0, period 1, period 2, period 3, period 4, period 4, I think. I can copy the cash flows. This is 50. Remember, this is a residual value. They are the same. I think I can copy this up to here. So I think we can now call this. Okay. So what is the annuity factor in year 4? Annuity factor in year 4. It's going to 1 minus divided by so what will be our ESC? So from here, it is evident that we have to replace asset machine A before replacing machine 2, because that's where we have the lowest ESC. So replace machine A before machine C, machine B, sorry. I think, I don't know if you have a challenge here again on this part. Any challenge?
Yes, what do you not calculate the cycle of each of the, for example, year 1, year 2, year 4, year 5?
Because we are looking at whether to replace, and this is a different decision we are looking at. We look at when we are not answering when should we, but we are looking at which asset should we replace.
Okay.
Yes. You only look at the other when you are looking at when to replace the asset. Is it okay?
Okay.
Hello.
Yes, please.
Yeah, for the previous example, we've taken a decision with the lowest ESC.
Yes.
Please scroll up and first we look at those numbers, then I can ask when I'm looking at them. Yeah. You see, the values obtained, they are all negative values.
Yeah, only that here I changed because these are cost, but only I changed the figures because but it's still the same. You could make this one a positive and make this one as a negative. It's going to give you the same, but it doesn't have any effect. Know that these are costs. This is an income. It may not affect your answer. You can check, make this one.
My question is, sorry, sir.
Yes, please.
Once all the values are negative, so I'm totally confused. Mathematically, if both are negative numbers, that one is not the lowest number.
Please, don't look at negative as a negative sign on mathematical number. Look at a negative in finance as a cash outflow.
Okay.
Yes, look at a negative in finance as a cash outflow. Don't take it as a negative sign on a number, but look at it as a cash outflow.
Thank you.
Okay. We are answering decision number 3. Decision number 3, the first decision in a replacement was we need to replace an asset. We have looked at that. The second decision was which asset to replace. And we have looked at that in a replacement. The third decision is whether to replace an existing asset with a new asset. Replacing an existing asset with a new asset. Replacing an existing asset with a new asset. That is our next part. Now, in this, you may be having two assets as we are looking at that. We have an already asset and you want to replace an already asset. I've heard someone knocking. You are replacing an already asset with a new asset, and you are making a decision whether it is viable to replace that old asset with a new asset. Now, when you are making a decision, the decision is based on incremental cash flows. What are the incremental cash flows associated with the two assets? If you evaluate those cash flows using the technique required, then from there, you can make a decision whether to replace or not. As long as you are having either positive NPV, an IRR that is above the cost of capital, in that case, or you have a PI that is above 1, then in that case, you are going to replace an existing asset with the new asset. If, for example, if you get a negative NPV, it will not be viable to replace the existing asset with a new asset. So, in replacing an existing asset with a new asset, what you do is to evaluate the incremental cash flows associated with the new assets. What are the incremental cash flows which are associated with the new assets? So look at the cash flows associated with the old asset and the cash flows associated with the new, and determine the incremental cash flows. So the decision to replace an existing asset with the new asset is made by so you are saying you are going to look at the incremental cash flows associated with the new asset and evaluate them using an appraisal technique. So you're going to look at the incremental cash flows associated with the new asset and evaluate those incremental cash flows using the appraisal technique. So, what are the steps here? Which are very important in this. Step number 1. Step number 1, determine the incremental investment costs. What is the incremental investment cost? Because you are purchasing a new asset to replace an existing asset. So it means the money you are going to sell from the existing asset will reduce the cost of the new asset. Then you are going to get the incremental asset. So you are going to have the purchase cost or the cost of new asset. Cost of new asset. Get the cost of the new asset less market value. Please mute. Market value of all the asset. Get the cost of new asset less the market value of the old asset. Then consider any tax saving or tax payment on the old asset. Tax saving or payment on the asset. How do we get this? Now, our tax saving or payment on all the asset. You're going to have the market value of all the asset. Market value of all the asset less the book value. the book value. Now, what you have here is either gain or a loss. It can either be a gain or a loss. If it is a gain, you'll have a tax payment. Then you recognize the tax. If it is a gain, you are going to have a tax payment. If it is a loss, you'll have a tax saving. A tax payment increases the cost. A tax saving reduces the cost. So here you can have either plus, or if it will allow, or a minus of that. Wow, it cannot accept. You will see how to not, but it can either be plus or minus. If it is a gain, you recognize the tax payment, which is going to be an additional cost. If it is a loss, you will have a tax saving on the loss and recognize a saving, which reduces the cost. So what you are going to have here is the incremental cash flows. Incremental investment cost. Incremental investment cost. Hope it is okay there for the first step. Step number 2. Step 2. Look at the incremental depreciation. Incremental depreciation. So what is going to be the incremental depreciation? Look at the depreciation of the new assets. Depreciation of the new asset less depreciation of all the asset. Less depreciation of all the asset. Look at the depreciation of the new asset, you less the depreciation of the old asset, then you get your incremental depreciation. That's step number 2, sorry. Because what we look here are the incremental cash flows. What are the incremental cash flows associated with the new asset you are purchasing? Step number 3. Step 3. You're going to determine incremental residual value. Incremental. My network is not stable. I don't know what has gone wrong. Incremental residual value. Incremental residual value, which you are going to look at still, the residual value of the new asset. Residual value of of new asset you less the residual value of old asset. What you are going to have is incremental residual value. So that is step number 3 when you are adjusting your incremental cash flows. Step number 1, you said you're going to pay the cost. Step number 2, look at the incremental depreciation. Step number 3, we are saying look at incremental residual value. Now, step number 4. Step 4. Determine incremental other cash flows. Determine incremental other cash flows. Look at the incremental other cash flows. Now, what you do here is to look at the 2 assets. Look at your old asset or look at the new asset. Then look at the old asset. And here you have the increase, the incremental. So look at, for example, your revenues. Look at the revenues. Now, what are the revenues associated with the new asset? Then what are the revenues of the old asset before the new asset is purchased? Then look at the increment. Now, look at operating costs. Operating costs. What is the current what's the operating cost associated with the new asset? What are the operating costs for the old assets? Then what will be the incremental? Look at working capital. What is the working capital requirement for the new asset? What is the current working capital requirement? Then look at the increment. Then these are the key steps to evaluate a project that requires replacing an existing asset with a new asset. So once you have these cash flows, what remains is to determine your net cash flows. So the step number 5 is to evaluate the cash flows. Step 5, evaluate the cash flows using appropriate investment appraisal.
Is it evaluate the cash flow or the free cash flow?
No, you are not. We don't have year 3. We are evaluating all the cash flows using an appropriate investment appraisal.
No, what I'm asking, is it cash flow or is it free cash flow?
We are not yet in the free cash flows. We shall discuss free cash flows, but we are looking at these incremental cash flows. We have not yet discussed the free cash flows. We shall discuss the free cash flows in another part. And I was planning to discuss it in mergers and acquisition, but we can also talk about it here because it's also used here. Now we start with your incremental revenues. Incremental revenues. Then you can have any incremental operating cost. You can have now your net cash flow or earning before tax, EBT. EBDT. It depends on my cash flows. I can consider the way we looked at it. I can less depreciation if I want that way, or I can compute the capital allowance on the depreciation. Depends. The tax saving on depreciation. Unless depreciation. Then I get the EBT. Then I charge tax. Charge tax. Charge tax. I get my EAT. Then add back the
Is it to less depreciation or incremental depreciation?
The increment. Okay, incremental. Add back an increment. Incremental depreciation. Then I'll have the net income. Then I can consider my residual value. I can consider my working capital, which can be positive, can be negative, depends. I can have my net cash, net incremental cash flows. Then I can have, depending on the appraisal technique I'm using, my discounting factor. Then I get the present value. Then from there, depending on what I'm calculating, I can get the NPV I can get the IRR, I can get the profitability index. But these are the key steps to do this question. So I want to give a simple example. Then we look at a question of 2021.
Excuse me.
Yes.
Excuse me.
Mm.
Before you go to an example, in this formula, you haven't included in investment.
Because I'm not putting any investment, because investment is going to depend on the technique we are going to use. If I'm going to use any PV, then it means I'll get the present value of the cash.
Oh yeah, I'm busy.
Present value of the cash flows minus the investment. If I'm going to get the IRR, still the same. I'll get the total to do the issue. So that one is going to come in any later stage. At any stage, you can add the investment, the incremental investment. Is it okay?
So it means even for that residual value, is it incremental and working capital?
You are saying?
After net income, we have residual value.
Residual value
Is it residual incremental value?
Incremental residual value.
Another question.
Yes.
On a residual value, on incremental working capital, are we going to subtract or to add?
Which one?
After net income, we have residual value. We are going to add working capital.
Working capital depends. Can be plus, can be minus. I don't know how I can put it, because it's going to depend on whether the working capital is increasing or is reducing. Can be plus, can be minus. Is the working capital increasing or decreasing? If the working capital is going to decrease, you're going to have a plus. If it is increasing, you'll have a minus.
Okay.
Yes. I first want to give a simple example, then we look at that question of 2021. Such that you will have, I think you can even do it yourself after this. think I've repeated this.
I think there is some word missing on a third sentence.
With expected residual value of 20 million at the end and depreciated over useful life.
Is it a continuity of the sentence number 3, number 2?
Yeah, it is a continuity. Don't know if I've captured all the information. Sorry. Let's go through the question together and see. And then from here, we can start, look at the other question I was telling you. Company X is evaluating replacing an existing machine with a new machine. The old machine was purchased 5 years ago at 100 million with a useful life of 10 years, with expected residual value of 20 million at the end, depreciated over useful life, meaning you are depreciating on set life. The current operating cost of the old machine is 15 million per year. The management are evaluating replacing the old machine with the new machine. I think that's a repetition. The purchase cost of the machine, of the new machine, should be the purchase cost of a new machine. Of a new machine is 180 million. Training cost of employees to use the machine is 5 million, and the installation cost of the machine is 15 million. The new machine has got a useful life of 5 years and a residual value of 30 at the end. The machine will depreciate on a certain basis over the useful life. Due to high capacity of the new machine, the operating cost is expected to decrease to 8 million per year. Furthermore, the new machine is expected to increase the revenues by 15 million per year. And these are the current. This is the current market value of the old machine. So advise the management on whether the old machine should be replaced by the new machine. So this is what we are having now. So what do we need? So what we need is the cost of the old machine. If you look at the data first, our data.
Can you give us 2 minutes to copy?
Okay. Hmm? Hmm. Can we start?
Yes, we can start.
So now cost of ownership is 100 million. We're going to reduce 3 zeros. Then our residual value of the old machine is 20. So it means useful life of the old machine is 10 years. So meaning depreciation of the old machine, the annual depreciation or the annual depreciation of the old machine will be, if I get it, this minus this minus the residual divided by 10. That's the annual depreciation. So accumulated will be the SEC depreciation of the old machine. Will be the annual depreciation of 8,000 times the period the machine has worked, because it has worked 5 years, times 5, which becomes, I think, 40. Which is 40. Now, that's the current accumulated. That's the current book value, the old machine. Current book value of old machine. Old machine. I think it's going to be the cost minus the accumulated. I get the current book value of the old machine. And the question gave us, maybe what I've not added, maybe you can add it. The corporate tax is 30%. I've not added that. The corporate tax is 30%. So market value of the old machine is value of old machine. The market value of the old machine is given as 45. This is the current book value. This is the current market value of the old machine. So it means in this case, we are going to have a loss. A loss on the disposal, which is this minus this. That is the loss. Having a loss, it means we shall have a tax saving on the old machine. A tax saving of 30% times 15. That's the tax saving on the old machine times 30%. Now, we can have the new machine. The purchase cost, we're looking at the new machine now. Our new machine. The purchase cost, they have told us is 180. We have training costs, because you add other related costs, get the cost. We have the training costs. Training costs to use the machine of 5. We have installation costs. Installation costs of 15. And it means our cost, the cost of the new machine is this plus this plus this. That's the cost of the new machine. Useful life of the new machine, is 5 years. So it means our annual depreciation for the new machine will be residual value. I'm not putting the residual value. Maybe I can write it here. Residual value of a new machine. The residual value of a new machine is 30. So meaning our annual depreciation will be the cost minus the residual value, then divided by the useful life. That is the annual depreciation for the new machine. Now, so if you look at this, now we can start our working one. These were data as I was summarizing, which we have also calculated some. Our working one is the incremental investment cost. And I have cost of the new machine, which is given as, which we have already calculated as 200. Then I less book value. So the market value, not book value, market value. Market value of all the machine. The market value of all the machine, I think we already calculated it when they summarized it up here, which is 45. We also have a tax saving.
But that's the way the annual depreciation of for the new machine.
You are saying?
No calculation of the annual depreciation of a new machine. Is it well calculated?
You can look at it. It is 200 minus 30 divided by 5.
Yes.
You get what?
Let me check. It is I have the problem.
Okay, let's tax saving. So what is the tax saving? We have already calculated it up there, which is this. So our incremental investment cost will be that. That's the incremental investment cost. Now, we also consider working number 2, incremental depreciation. Incremental depreciation. So we have depreciation of the new machine. Of a new machine, which is this one. Then we have depreciation of all the machine. Annual depreciation of all the machine. We go to what? 8. So our incremental will be incremental depreciation. So I just get this minus this. That is working number 2. Working number 3. Working 3. We have incremental residual value. Incremental residual value. So which we are going to have as residual value of new machine, which is given as 30, I think, which is 30. Oh, I forgot to add something on working capital. Let's leave that. We shall look at it in another maybe question. I forgot to add that information on working capital. Then I have residual value of all the machine. Which is?
Excuse me, sir.
Yes.
I have a question on this, on the cost of machine. Cost of new machine. There are some details that they normally put there, which should not be included in the cost of machine.
Like what?
Like testing. Is it testing?
No,
I want you to help us. I want you to help us to know. You know, that part is somewhere how
do you determine the cost of an asset as per the IS 16?
You get the purchase cost and
plus
you add the related
costs to make the asset to work.
Yes.
Like what? Training of employees on how to use the asset is included. Installation cost is included.
Yes.
So what have I put that is not there?
I'm not saying that you did not put what was not there. I wanted you to tell us. There is a question that I don't remember that I saw. it had a lot of things which was there to confuse us on the cost of new machine. Maybe it is that question that will solve, but no things that they normally put there.
Okay.
Like the testing.
Okay. The testing, but testing is not included in as per IS 16 before the asset is going to be used. Those are installations. Yeah.
Okay. Well, no problem. Let's continue.
Okay. So increment. Incremental residual value will be so working number 4. We're going to look at the incremental other cash flows. And we have our new machine. And we have the old machine. Then the incremental. So if you look at our question, we were talked about the operating costs. I didn't cover them in our operating costs. They told the operating cost of the new machine will be 8. The operating cost of the old machine is 15. So we have a decrease of this minus this, which is a saving in operating costs. Then they told us again, but you can take it as a positive, I think. Okay, let's make it a positive. We have an increase in revenues. Increase in revenues. We have not been given the revenue of the old, but they told us the increase in revenues is going to be 15, I think. The increase in revenue is 15. So our incremental revenues would be 15. Unfortunately, I forgot to add an information on on working capital, but okay, you can know how to adjust the working capital. So that is be the incremental income. Incremental incomes. Yes, please.
The operating costs for the old machine is 15,000, and the operating cost for the new machine will be 80,000.
The operating, yeah, it's 8,000. So what is the incremental?
Is it an increase?
No, it's not an increase.
Yes, the new machine.
It's a decrease, but it's an income. Because your operating costs are reduced.
The incremental will be...
No, that is my network, or it's
no,
network.
I don't know the appropriate term. Okay.
Incremental does not mean that you are only looking at the increase. Incremental means decrease or increase? I accept it is a decrease in operating cost of 5. That's why in the first we had a negative, but because I wanted to add them here, that's why I've removed the negative sign.
Okay.
Yes. Now, we can now get our net cash flows. Please mute. Olive. We are going for our net cash flows. Our net cash. Please mute your microphone. Now, let's look at our net cash flows. First, I think we have finished all the workings. We have our incremental, income, which is working in number 4.
Sorry, sir.
Yes.
If, for example, the increment was of sign plus, I have the new machine have the 80,000 and the old machine have 50. Then it means the sign could be minus.
Could be minus, yes.
Yes, minus and the 50 could be 80 incremental in income. Why it becomes 22?
Because our operating costs have reduced, it is an income.
Okay.
Yeah.
If the increase, it becomes the expense.
An expense, yes. So it means should reduce as your other incomes.
Okay.
So my incremental income, I have it, which is this. Now, what we do here, since our cash flows are going to be constant, we are going to less depreciation. My depreciation incremental. Let me add the word incremental. Incremental depreciation, which is working in number 2. Which is this. What I get here is a loss of this. I get a loss of 4,000. Now, after this getting a loss, since I have a loss, I'm going to have a tax saving on loss. I don't have a tax payment. I'll have a tax saving on loss. Of course, at 30%. I'm not calculating the tax payment because I have a loss. It is a tax saving, which is going to be this times 30%. I have this. Then it means my earnings after tax, if it was an income, I would have calculated tax payment. But since it is a loss, I only have to calculate a tax saving. So know how to play with your data. I get this. Then I add back depreciation. Add back a depreciation, which is this. So my net income will be that. That's the net income. Now I can make this in a simple terms that can be easily understood. So I can say I have the item here. I have the period. I need to copy a bit down. I have the period. I want to make it in a simple terms. I have the cash flow. I have the discounting factor. Then I have the present value. Period is, I have incremental investment cost. Incremental investment, which is in period 0. And I can take my cash flows, which I calculated in working number 1. Where is it? Working 1 is here. Then I have incremental income. Incremental net income, which is from period 1 to 5, which I've calculated at 23. Then I have incremental residual value, which will be in period 5, which we got as incremental residual value. We got 10. So what's the discounting factor? Is 10. We're using 10%. Is it 10%? Our cost of capital. Did I give you the cost of capital?
Yes, sir. It is 10%.
10%. So our cost of capital is 10%. So it means period 0, it will be 1 plus 0.1 power minus 0. Here it's going to be, because it is annuity, 1 minus 1 plus 0.1 power minus 5, then divided by 0.1. Because I'm dealing with an annuity. Here, it's not an annuity, it is a lump sum. It's going to be 1.
Sorry, sir.
Yes.
The cost of capital is not given. I can see that it is for 10% is for the first question that
Let's
we
assume it is
did.
a 10%. Remember, I'm going to add that information. The cost of capital is 10%. I'm going to add
Okay.
Okay. Power minus 5. So the present value It will be this time was this. Here, this time was this. Then here, this time was this. So if you are to get the NPV, our NPV, you're using the NPV rule to evaluate this decision. Automatically, you're going to reject. The old machine should not be replaced. If you look at the if you're using the NPV rule, the old machine should not be replaced. So you are rejecting the decision. But I need to add that information. The old machine should not be replaced, since the NPV is negative. So you shouldn't replace the old machine with the new machine because you are going to make more loss. But I need to add that information in the question because it's not there. That our cost of capital is 10%. And the cost of capital is 10%. You can add it if you have written the question. So that is how we do a replacement. I don't know if you have a question on this. Any question on how to make these adjustments? I can now copy the other question down here. We can go through it together and we see whether you can handle. Yeah, I've already skipped there. Some pages are already missing there.
Doctor.
Yes.
Are we not taking a break?
I thought the first break is going to be after we have finished this, but we need to finish investment today.
Okay.
The whole investment must end today. We're still having 2 parts.
Okay.
Let's go through this question. I thought the first break is going to be after APV. And the APV is a very common question. Let's look at this question of August 2021, and it is question 1. MCM Limited is a company engaged in the pressing and the processing of sugar cane juice into refined sugar. For some time, the company has been considering replacement of their three existing machines. The production manager has learned from the professional newsletter on sugar for the availability of a new and large machine whose capacity is such that it can produce the same level of output per annum currently produced by 3 machines. Furthermore, the new machine would cut down the wastage of juice. That is a deduction reduction in juice during processing. If the old machines are not replaced, an overhaul would be immediately necessary in order to maintain them in operational condition. So this overall would cost, so that's an opportunity cost. Then if you go down, it says,
how is it an opportunity cost?
Because when you make an overhaul, when you don't, if you purchase a new machine, you'll have to that's for me how I'm interpreting it. Maybe I've interpreted it wrongly. If you don't replace the old machine, you'll have to incur that cost. But if you if you replace, you will save that money. That money will be saved. Is it what? How do you call it?
It is opportunity.
That's what I'm thinking. Now, the following additional information is available. The old machine we have purchased 5 years ago, and we have the data on use old machine. Data on old machine. On old machines. Data on old machines. Useful life. Useful life is 5 years. 15, sorry. They have 15 years. And they are depreciated with estimated final scrap value of 600 for each machine. Remember, there are 3 machines. So residual value will be 600 times 3. I've reduced to 3 zeros. 600 times 3. That's the residual value of the 3 machines. The current scanned market value of each machine, the current market value is 1 million times 3. That's the current market value of the 3 machines. The annual operating costs of existing machines, those are the operating costs. Maybe I will need them. I will need these operating costs because I need to put them somewhere. This is the old machine. Old machine. These are operating costs. I can put them up probably. Then I will copy down because the information is going to get fragmented and we may lose it. Operating costs. We have, I would have loved to put it different, but raw sugar cane, raw sugar cane. It has, operating cost on raw sugar cane is 60. Labor, 1 operator. It is 1,350. Then I have variable costs. it is 925. Maintenance, it is 2. And then I have the current depreciation. The depreciation of the asset. Fixed costs, we have the depreciation and fixed factory overheads. Depreciation is 75. These fixed factory overheads, I don't know whether we are going to, so it's going to be 75. If you have reduced 3 zeros, I think. I may not take this fixed offer. Let me first go down. Maybe I can take them, or I may not take them. If they are fixed, then we may not take them, unless they are going to be changing. Now, if you go for the new machine, has estimated life of 10 years. If you look at the new machine, the new machine, useful life, is 10. And then purchase price value. Purchase price value is 4.5. The purchase price value in 10 years.
On all the machines, are we going to add the depreciation on the fixed factory overhead?
Huh?
On the fixed costs?
Since they are fixed, I've left them out, but I want to see the other cost down, then I will see how to handle. I will see if they are incremental or they are not incremental. That's what I want to see before I add them. The machine has estimated life of 10 years. Initial cost will comprise the initial cost of the machine. Initial cost is 100 million. Then if you look at that's why I wanted to make this one. The operating cost. Can I say this is old? Then I put there new. And I copy the same data down here.
No, but lecturer, you should remove also depreciation. You should also remove depreciation because depreciation is the under fixed cost.
Okay, but I wanted to use it, but okay, we shall look at how to handle it. So I wanted to summarize this data here, such that we can easily get the incremental. The sugar cane will increase. I cannot because it is, the information is this.
Well, what if you duplicate those information is on a new machine?
On down here?
Yes.
Yeah, I think it's better. Otherwise, the head had blocked. It couldn't think anymore. So, sugarcane, we're going to increase by 162. This is labor is increasing by is increasing to 3,900. Whether I didn't read whether this was for one machine. Okay, I need to check that up there. Whether I need to multiply by 3. Because these are 3 machines. Then variable costs, they become 275. Maintenance would be 4.5. We said we are first ignoring the fixed costs. Can we check these ones? I want to see here something. The annual for each, it's for each machine. So I have to multiply by 3 because it is for each machine. Times 3. The cache is blocked. I don't know if I will remember this. Now, if you go down here, I want to check this fixed overhead costs. We have fixed factory overhead costs. But if you look at this, these fixed factory overhead costs are changing. Let me see fixed overhead cost. Here we had 2.7 times 3. 2.7 times 3. It was 81. And here it's going to be 78. So it means this one is not fixed for factory. It is going to change based on the machine. Two, 7, 2, 7
times 3.
times 3. Okay. Now which other data we have?
Where do you get that 6,000 for maintenance? All the machine.
Because it is each machine. These costs are for each machine. That's what the question has said. So it means I have to multiply by 3 for each cost.
Oh, okay.
Yes.
But also we need to change on the data given all the machine.
For the old machine?
Yeah, up there. Yes, there.
Yeah, I multiplied by 3.
No. On operating costs.
That's what this is the one I've copied down.
Oh, okay.
So now, if you look at this, the company's cost of capital is given. Then what number 6 says, the project to be implemented must first be cost of capital as indicated by- Please mute. But its internal rate of return and the financial viability test in that it must pay back within maximum period of 5 years. Then they have told us to ignore taxation. Since we are ignoring taxation, we don't need a tax saving on the other data. So can we start now? Our workings. Working one, we are discussing incremental investment cost. So we have the cost of a new machine, which is 100. Then we recognize an opportunity cost of replacing, which is 5. And I think we get 105. Now, what is the current market value? Yes.
Excuse me.
Yes.
I don't understand how opportunity cost of not replacing the machine will be in the incremental investment costs.
So, if you are to replace the machine, how much will you incur?
The 100,000. I mean the cost of new machine.
If you are to replace, if you don't replace the machine, how much will you incur?
This 5 million.
So, what will be the cost to replace?
The cost to replace will be the cost of buying new machine. Of buying new machine.
Only, what about the 5 million? Where are you going to put it?
I don't understand.
Maybe I'm the one interpreting it wrongly. Let's go back to the data. Maybe I'm the one interpreting it wrongly. Maybe the one making a mistake. For me, I'm seeing as if it is going to increase our cost. The production manager has learned from professional news rate of that. That one is not. If the old machines are not replaced, you'll have to make an overhaul. So is it going to be a saving, an additional cost? That's the challenge I'm facing now. If you decide to replace the machine,
if it's not replaced,
if you don't
incur
replace it.
Yes, if it's not replaced, it will incur additional cost of 5 million.
So if you replace,
yes. If you replace, then we shall need the new machine of 1 million.
So what about this 5 million? Is it going to be an additional cost or a saving for replacing the machine?
You see, if we replace it, we are not going to incur this 5 million.
Yes, I concur. If we replace the asset, we are not going to incur the 5 million.
Yes.
It means you will receive.
Take it as, yes.
You receive the 5 million.
Yes.
Yes, I may accept, but if the machines are to be replaced, you will pay the 100 million, but recognize the saving of 5 million.
which in turn will reduce the cost, which is going to reduce instead of increasing this cost. Yes. Thank you.
Yes. Then since we don't have tax, we are not going to calculate the tax saving. Hey, we have still we have the market value. We have already got that. The market value, we have already got 3 million, I think. The current market value of the 3 machines is 3 million. So we are going to have how much? 92. Now, if you go to the incremental depreciation, working number 2. Incremental depreciation. What's the depreciation? Depreciation of the new machine. Depreciation of the new machine, they have given us as 7.955. 9?
Lecturer.
Yes.
My question is about why do you include in the investment costs these opportunity costs?
Over? Now.
For me, it looked like an operating cost or an operating advantage benefit.
That's why I put a negative, but I needed to, really, I needed to, for me, I see, the way I'm looking at it, but this is not my question. The way I'm looking at it, you have an existing machine which are operating. If you don't replace these machines, you are going to incur. You are going to make an overhaul, and the overhaul cost is 5 million. If you don't replace them, you are going to make an overhaul of the machines. So what will be the cost? That is going to be a cost of the old machines to make an overhaul. But if you decide to replace, you're not going to incur this cost. So will our purchase cost increase or decrease? That's, I think, where we're having an issue. Will the purchase cost increase or decrease?
The purchase cost will not be affected, but we shall simply save this 5 million, which we are going to spend.
Which we are going to spend.
Yes.
That's why I concur with you on that. Okay, we shall look at it, but that's information that is a bit challenging and they can make us fail. So depreciation of old machine is going to be 750 times 3. $750 times 3. Then our incremental will be incremental minus this. Then you can recognize the incremental residual value. That is working in number 4. incremental residual value, which is going to have the residual value of the new asset which is, they have told us 4.5, the residual value of the new asset. It is 4.5. It is here. Value in 10 years. $4.5.
That is working number 3, not number 4.
Yeah, number 3. Then value, residual value of all the asset. Residual value of all the asset. I think we calculated it. It was 60. Residual value of all the asset. It is 180. So, and I get our incremental, get this, minus this. I think then what we need is the incremental operating costs as a working number 4. Incremental operating costs. I'm just going to copy the other data that we had already summarized here for incremental operating cost. This is our new machine, like this. So what is the incremental here? Incremental for sugarcane, we have this minus this. For labor, shall have this minus this. This will be this minus this. Still all this we are saving. There's nowhere we are incurring additional costs. Minus this. We are going to make a saving of how much? Okay, I think we have everything. We can now start our net cash flows. Maybe that's going to be work number 5. Net. I think I have not interpreted the other information well. Net cash flows. Now, we have incremental working capital. Incremental operating cost. With, which is this? Less depreciation. Our increment, of course. Incremental depreciation, we calculated it as but remember, we don't have tax. So you are going to add back the same depreciation. This is earning before tax. So add back. You could as well ignore depreciation since there is no tax. But for max, you can do these workings. but you could as well ignore it since you don't have tax. Add back a depreciation. Now that is the net cash flows we have. Net cash inflow. Now what we need now is to evaluate. Once I have the cash flows, I can evaluate. I have the item, I have the period, I have the cash flow, I have the discounting factor, which is what? The discounting factor in the question is what? Hey, I've already removed it. %, eh? Discounting factor at 10%. Then I have the present value. So investment, please make this one, try to make, I'm not convinced, I don't know why. At this point, I'm thinking that we are making a mistake somewhere in this. We are getting 92. Is it 92?
Yes. Yes.
Our net cash in. Our net cash. Remember, we are from period 1 to 10. From period 1 to period 10, we have got this. We have incremental residual value. In period 10, we got I think it is this one. Sorry. So this will be 1 plus 0.1 power minus this. This will be 1.
Excuse me, sir.
Yes.
The mistake is on depreciation. On the old machine, we have only 75,000 times 3.
I took a wrong figure.
Then on the new machine, it's a big number.
Okay, let me, okay, I'm going to correct. Let me calculate this.
Yes.
Plus 0.1 power minus 10 divided by 0.1. Where? Huh? Is 1 minus okay. I copied the wrong figure, it seems, for this incremental depreciation. Isn't it this? It is this 955 to 250. Can you check your incremental depreciation?
So on new machine, it's 9,550,000. Then on the old machine,
It's
it's
75
only
times
75 times 3.
3.
So if you reduce, you remain with 9,325.
75 times 3.
Yes.
You get what?
Look at the answer.
No,
The answer
what do you
should
get?
be
75 times. What do you get
9,325.
75 times 3? I want to first get the answer, that one. 75 times 3. What do you get? Put on your calculator.
250.
2? Isn't it
Can we
correct?
check on the
Remove 0. It is 225.
yes, it is 225.
Yes.
No 50.
No.
Unless if it is per one machine, it is 75.
It is 75.
You can check on the data. If it is 75, it is 225.
Okay. I think it is 75. We should remove 3 zeros.
Yeah, it is 225.
Here. Okay. I think it's now going to be automatic down here. But our cash in is not affected, eh? Our net cash flow. And what do you have here? It is 1 plus 0.1 power minus 10. So what is our PV? This times this. So if you add here, you have this. But remember, the question required us to get IRR, to evaluate this decision using IRR. That's what the question required us. Did it give us a clue on what to use as discounting factor? They want us to use 10 to 20. It means my next part is going to be 20. Please, whenever you are given this one, don't put your own. They told us to use 10 and 20. So I'm using 10, then I have a positive. Let me see the 20. Don't create yours once the question has given you the rates to use. So I'm going to copy this. Ooh. I'm copying this here. It has moved away. How can I copy it with the formula? If I copy it here, it is not coming out. The formulas are moving away. Fx, this one, but it doesn't take the formula. Eh? So just copy the formula. So it's not. Ooh. I think this. I see no formula. Nothing to do. Does not copy the formula.
It is right.
Huh? The good I have the cash flows, I can maybe copy the formulas. Ah, wow. I've destroyed everything. What I needed, this one has not changed. I'm not changing this. But this one, I have to put a new formula. I'm changing this one to 20%. Oh. At 20%. So, but you can read this in your table. 1 minus 1 plus 0.2 power minus 10 divided by 0.2. Then here I have this plus 0.2 power minus 10. Now we can interpolate our IRR. Since we have the positive and the negative. So our IRR will be equal to 10% or 0.1 plus 34, I can say 34, if you can put a bracket, 34, 697, 0.2 plus 0.1 over 34, 697, plus minus becomes a plus, 5, 828. What have I done? Can you get me the answer now? Please don't take a lot of time.
It's 18.56.
18.56. Now, since our IRR is above, the project should be accepted. The asset should be replaced. Since the IRR is above the target cost of capital, the old asset or the old machines should be replaced by the new machines. I think that way. I don't know if you have a question, but I would like to copy this data down because they are fragmented. Any question?
We want to see the conclusion.
Okay, I'm copying it to where we are working from. Okay. So this is the first part, which is about replacement. I don't know if you have a question, and or we don't. When should we have a break? But remember, we have to finish investment today. Tomorrow we start something new.
I take a break now, sir.
And we come back at what time?
After 40 minutes.
At 1.
At 1. Now in Uganda, it means that. Okay. Okay, now when we come back, we are going to look at the adjusted present value.
But I wish we would take a break after 30 minutes.
No, take a heavy break first, yeah? After 30 minutes? The consensus. So what did you take?
Can we complete this
take it now.
the present value? We take break after present value.
We take a break after this one.
No, it's
Yes.
a very
No,
long
we are tired, sir.
We are tired. Let's have a break.
We should have a break and we will be back after 40 minutes.
You know, always give ladies the first alternative, the first choice. And I think I'm
Yes.
hearing the majority of ladies are saying they are tired.
Yes.
Eh?
Yes.
No, we are not tired, but we are hungry.
The
majority is the voice of God.
Please take a heavy breakfast. When we come back, oh, it's heavy lunch now.
Hey,
Mix
So
the
we
two.
come
then
back.
we shall be back when
No,
we
we
will
are coming
be
back
fresh.
at 1. at 1 because we needed to finish it.
Yes. Yes.
Yes.
Because there is a member
Exactly.
who has another class, and we need to allow him at 4 to go. At 4 we finish.
Lecturer, at 1 is too short.
No, for 30 minutes you can. I'm also going to eat something within 30 minutes, and I'm going to cook. 30 minutes.
It is enough.
30 minutes is enough to
30
prepare
minutes is
something. Yeah, 30 minutes. Okay.
But excuse me, sir.
Yes.
Before we go to APV,
Mm.
you haven't told about simulation
Simulation in risk.
in investment appraisal.
In risk. That is in a risk.
It's in risk.
Yeah, incorporating risk.
Okay.
But we were confused on that because we were not able to differentiate the risk and uncertainty.
That one is maybe what you look at the sensitivity. I didn't talk about this. I didn't even explain the word simulation. This was
You didn't. There is no simulation
because what I
there.
said, there is no calculation that are given here. What we need is the. I didn't explain it. There is no one word simulation.
But what I'm asking, we don't know whether there is technique of appraising investment under uncertainty and other
Under
technique for
uncertainties, you are taking me to your management account. I mean, performance management. Me, I don't want to go there. To look at this, the maximum, what minimax, because those are the one we use in a decision.
So in corporate,
the minimax, the maximum. No, we don't go there. We want to look at these risks.
So in corporate, we mix them.
Yeah, we don't go into the minimax, the maximum, because that's where you are putting in the uncertainties.
Okay.
Yeah. Simulation, I said, in a simulation, the whole of variables are combined together, and you simulate them to see how they affect your NPV, but combining the whole of variables together. Maybe I didn't write, but I only explained it here. I think that's what we do in simulation. We will combine all the variables together and see how they have an impact the NPV. But we use computer software to do the simulation. Okay, I think we can have now this break, and after break we are going to discuss APV, which is very common question.
Let's copy the note you put on simulation.
It's a very common question. Please ensure that you get it. So let's have a break, then we'll come back at 1 for 1 and 5 minutes because you have consumed 5 minutes.
STO bite se? Meze neza. Aha, ndimo ngiye kukoherereza fayiro irimo ibyo bintu byose, ariko ikintu ndashaka ko printinga ari impapuro zitambitse. Donc kakaba ari agatabo gatambitse gatoya kabisa, kuko ibitabo binini kubitwara muri examen biravunana kandi binatwara okay, ubwo ngubwo kanze mbikoherereza kubera ntabwo nimugoroba byakunda, kandi ubu nanze kuguhamagara mu gitondo mvuga ngo wenda ngo wagiye ngo kuri church. Ndahiye kabisa. Ejo se ko ari amatora uzabikora ute? nta n'ibireka mbikoherereza. Fred, ndakureba we mushuti wanjye. Yesu wanjye, biri unmuted? naba ndaburije mwana. Jesus.